Hello traders, Gary Wagner here. Approximately 12:30 in Honolulu, 6:30 in New York. It is Thursday, 29th day of April 2021, and this is the daily report for gold and silver. Gold traded to a high last night of 1790 before the advance estimate of GDP numbers came out with a solid performance for first quarter GDP at 6.4%. That took gold to a low of 54 and change before recovering to, in essence, unchanged on the day. That did hit our stop, and we effectively pulled profits. We'll talk about that during our price board as well as our studies. The show begins now. Recent economic events, including the forecast in advance of the first quarter 2021 GDP, the subsequent all-time record highs in the Standard & Poor's and uptick in yields, resulted in pretty wild swings in terms of gold pricing today, with over a $40 range. It traded to a high in overseas trading last night of 1789.80 and then to a low of 1754.60 before recovering by the end of the day in current pricing at 1772, putting it down $1.90 on the day. Today's lows did stop us out. It stopped us out in a profit. We will talk about that when we pull up our first gold chart. Traders, the extended range definitely came down and hit our stop. We had a stop at 1760, long at 1744. Profit of $1,600 per COMEX contract on the trade. I want to take a look at gold, short-term as well as long-term today. We will begin with a short-term view. I have added an extremely short-term Fibonacci retracement that begins at the end of March. Gold was trading at 1673 up to the most recent high, which was just shy of $1,800 per ounce. Assuming that we do see some continued weakness in gold pricing because we have declined over this last week off of those lows, where could we see gold actually trade to and find support? If this is a true correction, today's low came close to but did not take out the 38.2 Fibonacci retracement. That occurs at 1752, breaking below 1772, which is where we were looking at as a key and critical level of necessary support. We did close just at that price point. In other words, we did have a recovery, so we could just be seeing a very, very short-term weakness in the market. However, a further decline could take gold as low as 1723. That is the 61.8% Fibonacci retracement, although I think it is more likely, if we see further selling, to see the market decline to about 1737. That being said, I do want to take a look at our long-term studies that include our major Elliott wave count along with our longer Fibonacci studies. When we look at current activity that goes back as recently as the beginning of the pandemic, that would be back in March of last year. That was the conclusion of a corrective wave 2. What followed was a move to the all-time record high. That occurred mid-August, and that was a third wave and the conclusion of that third wave. We then saw gold begin to trade in a multi-month correction lasting really from August all the way through the beginning of March of this year. We talked about this on numerous occasions. We did get a conclusion to our major fourth wave here. We did see the market trade to a double bottom and then move into rally mode. However, when we look at the shorter term studies found within this Elliott wave, what you can see is that we have completed a 5 count, which looks something like this. We concluded our fourth wave here. We then had our first impulse wave, which was wave 1. That was followed by the double bottom, which is labeled as 2. We then took us to the recent tops, just shy of 1800, as a third wave impulse move, which could mean that current Elliott wave count is signaling the beginning of some sort of an A, B, C correction. If that is the case, we will see a further decline, and following that, we will see a fifth wave. The fifth wave will, by nature, have to trade above the highs achieved of this third wave when market forces took gold prices near 1800. That would mean an effective close above 1800. While our shorter-term forecast could be indicating potentially lower pricing over the next couple of weeks, The big picture, meaning what we will see over the next year to 2 years, is extremely bullish because we are firmly in a fifth wave. By nature of that, the fifth wave would have to overtake the top of this third wave that occurred in August. This is not short term by any means. We're talking about a year to a year and a half out when we believe we could see gold take out 2,088 and trade as high as $2,160 per ounce. Silver also had an increased trading range today as it traded to a high of 26.28, a low of 25.73, and is currently fixed at 26.13 with the net change of 4.5 cents on the day. Our technical studies in silver indicate that there could be very strong support due to the nature of these multiple moving averages. Although the Elliott wave is saying we could trade as low as approximately 25.50, we are currently in a fourth wave decline. That would be followed by a fifth wave that by nature would have to exceed this particular top, and this top comes in at about $26.75. On a technical basis, we are showing strong support for silver at $25.46. That corresponds to its 200-day moving average. And lastly, I do want to continue our discussion on copper. Copper today closed at $4.49 per pound. That is a decline of 0.8 cents. It is quite easy to see that copper, in terms of the technical indicators, are in full bullish alignment, with the shortest term moving average, that being the 21-day exponential, being the highest, followed by the 50, 100, and then 200-day moving averages. Copper, to say the least, has been on a tear. However, when we look at the highest monthly close, that comes in at $4.49 and change in terms of the pound price, we can see that yesterday it closed right at that price point. Today it closed slightly lower, but also at that price point. So the question is, will we see some resistance come into the market, a slight correction, and then go to take out the all-time record high in copper? And that, of course, occurred at $4.66. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.